Welcome back, you legends. I'm Dr. Cal, and let's get right into this quick market update video. S&P, NASDAQ, Russell, and Dow Jones all green on the day in reaction to better than expected PPI. So the producer price index came in at 2.4%, significantly below the consensus at 2.7% and below last month's reading. By the way, this is an exception because over the last several months, because we had PPI rising pretty much every month, both the core PPI and the headline PPI. Look at this trend. Continued to rise February, March, April, May, and June, all showing PPI rising month over month and year over year. July was the exception. The market really needed PPI to come in below expectations this month to continue that rally off that key market bottom that we discussed last week, and it happened. By the way, I did put out a note Monday morning. By the way, 4 p.m. my time is about 9 a.m. Eastern time. So I put out this a market note before the market opened, and I said that I was bullish on PPI and CPI this week, and I expected both reports to be in line or better, and that any dip before or after the reports should be used as a buying opportunity. And as you all know, I follow my own advice. So I did buy. I did go in long Monday. I went long a specific name and I took profit today. And I expect to go long other names right after CPI in reaction to CPI. All indices in the green, led by the NASDAQ. That's a big thumbs up. You want to see tech leading the rally. That's what should. That really is what should happen in a healthy uptrend, led by semiconductors. Another big thumbs up. I talked about semiconductors bottoming. I obviously post every day on the Discord trading community. If you Google Money Time Machine, you'll find my Patreon page. It's the best possible way to keep track of all of my market notes, my trade setups, overall market outlook, and follow my trades and ask questions if you have any questions. It's also obviously the best possible way to support the channel if that's something you want to do. So why is the rally in semiconductors important? Well, because semiconductors, including NVIDIA, topped before the market did, right? We had this bearish divergence where NVIDIA put in this lower high versus the high in June, right? This is the mid-July high, and it was a lower high. It formed this double top, and it broke the neckline and gave us an objective downside target of $94.8. We ended up bottoming just a couple of dollars below that. Let me layer the NASDAQ 100 on here so you guys can see what I'm talking about in terms of this bearish divergence. So this is the NASDAQ 100 in blue and black, and the NASDAQ put in a higher high. So this was a key bearish divergence, and it told us that a larger than expected correction was going to take place. That's why I put out a note on the Discord community exactly as the market was rallying here, exactly as NVIDIA was rallying here, not to enter NVIDIA. I warned everybody, do not enter NVIDIA here. We're going to get a correction. And as you all know, I always keep receipts. Here it is, July 12th, exactly as the market topped right here. I posted this note in the trading community. A quick update on NVIDIA. Looks like a classic double top with a second lower high. This double top has a neckline at 118. When this neckline breaks, it will confirm a full measured move down to about $99. This is not a pullback you want to buy in NVIDIA. Again, July 12th. So all of this is why semiconductors leading the market right now is very bullish, because they showed vulnerability, and it's quite often the case in very significant market reversals. Semiconductors will put in the top first, and then the rest of the market will follow. This was true in late 2021 when semiconductors topped several months before the market put in the final top. That's why it's crucial. That's why I always follow semiconductors, because where they lead, the market follows. And a lot of folks were really worried, is this the final top for the market? Is this it? That's not my opinion. I don't think so. I think we still rally all the way into the end of the year, with the exception of September and October, where we get that seasonally bearish sell-off in election years, right? September, October, both tend to be negative. By the way, I went through all of this in my last video. It is pretty long. However, I did go over all of these scenarios that I expect to unfold this year, including how this month is going to play out. September, October, November, December. I go through all of them. Okay, so let's get right into the daily chart for the S&P 500. This was a classic bearish rising wedge structure. These bearish rising wedges usually break to the downside. Obviously, in this instance, I was bullish on both PPI and CPI. So I was expecting a rally to this neckline that I discussed in the last video. We ended up exceeding that neckline. So that's where I expected the market to rally. In fact, I put out a note in the Discord community saying that this is an air pocket. In air pockets, usually price will move very quickly. In fact, I put out a note yesterday saying that we will likely see a gap up and a rally toward the 538 target, where this air pocket will remain an air pocket. We gapped down and likely we will gap up through it in reaction to PPI. Now, what's really interesting is that my expectation was a rally to this target, and then for the rally to begin somewhat to weaken, and then we get a pullback. Now, that is no longer my baseline expectation, and here's the reason for that. 538 was a clear pivot level, meaning it was support once, twice, then we broke through it. The third time, it acted as resistance. Now we're back inside of this level. We have recovered this level. This tells me that 538 is now support, and the more likely outcome is that we will rally all the way up to the top of this range, this very clearly defined range, to it should say 547. Let me correct this number, 547. So all the way to the top of the range, and then we pull back to the bottom of the range, and then we continue the move higher. That's now my baseline expectation based on how the market behaved yesterday. We have recovered 538 on the NASDAQ 100 hourly chart. We have an even bigger development. So we opened at 456, which was my target. If you watched my previous video, not only that, we have opened above. Look at this, above this major resistance line. Stop this rally, rejected this one, rejected again, and we consolidated right below it, and we now opened above it and continued to rally. So this was a gap and rip, and that tells me, again, likely a rally all the way to the upper edge of the range, potentially even higher for the NASDAQ. I could potentially see the NASDAQ rallying all the way up to 471, in fact. But let's just keep it conservative. It doesn't really matter if we rally to 467, 471. It really doesn't matter that much. What really matters is what happens next. So my expectation is still that we continue to the top end of the range, and then we come back to the bottom, and that is the pullback, right? That is going to be the pullback. That's now my baseline expectation. That's now where I expect the pullback to take place. No longer do I expect the pullback to be much deeper than that, simply due to the more bullish developments that we're seeing now. PPI coming in much better than expected. Likely CPI will do the same thing. And it makes no sense to continue to be stubborn and say, okay, we'll maintain our targets. We'll maintain everything as is, even though we've gotten more data, right? We have to adjust based on the information, the best available, latest available information and data. And that's exactly what we like to do. And that's why we always need to be agile as traders. We have to be agile. We have to constantly update our outlook based on what the data says, not how we feel. Now, with all of that being said, it is quite rare. It is very rare. And it's not just my opinion. I've seen quite a few technical analysts that I very much respect, including Michael Silva from Figuring Out Money, one of my absolute favorite YouTubers. Please give him a subscribe and watch his videos. He's absolutely phenomenal. I learned a lot from him. Now, it seems even he expected that this wedge would break down. My expectation was slightly different. I expected we probably gap up and then give back those gains. Now that we've made those significant developments on the hourly charts for the S&P and the NASDAQ, specifically, especially the NASDAQ opening above this resistance line and continuing to rally, I think it's more likely that we continue to the upper edge of the range, this prior range, very clear range. We continue up that range and then likely just get a pull back to the bottom of the range and continue higher into the end of the month. That is still my expectation. My expectation is still a multi-week rally until the end of the month. Now, the daily chart still looks bullish, still looks like a major V-shaped recovery in the market. Stochastic is positive. The RSI is now above 50, a crucial development. It's also above the moving average. We're still in an uptrend, and we will likely continue to rally higher. Now, end of the month target is still around this prior neckline. That is around 535. That's around 553, 554 for the SPY. Update it as necessary. However, that is still my target for the end of the month. That means I'm still expecting something that looks kind of like this rally to the upper edge of this range, come back down to the bottom of the range, rally again, realize this target, right? And that would give us the top at the end of August. Here it is, 27th of August. That's likely when we will get that top and then move back down in that second wave of the correction in September and in October. That is my expectation at this point in time. It could really change based on what the Fed does in the September month. We already know the Fed is going to cut rates. However, if the Fed, for example, cuts more than expected, that will be bullish. In my opinion, that will be seen as bullish. If the Fed signals even more aggressive rate cuts in November and for the rest of the year, again, that would be bullish in my opinion. So this is just based on the data that we have right now in terms of what the market is expecting in terms of rate cuts, and that will easily change based on what we see in terms of unemployment data, more CPI and PPI reports, and so on and so forth. For the NASDAQ 100, this, by the way, everybody, this purple level is what I would call a pivot level. It was a prior level of resistance. Boom. Then it switched to support. And then we broke through it. It acted as resistance again, and it is now acting as support. So it's a pivot level. Whenever you're trading above a pivot zone, it acts as support. Whenever you're trading below it, it acts as resistance. We're not trading above it. That means I expect 537 to remain support from this point on until the end of the month. NASDAQ 100, pretty much the same thing here. Key pivot level, resistance, then support, broke down, recovered. It is now acting as resistance. That is 456, should act as support as we continue to rally higher into the upper edge of this range. And then if we come back, that will act as support. Get that second wave of the rally into the end of the month, and that should be that. Now let's take a look at the futures chart. This is the S&P 500 futures. We're still trading below this key resistance line, unlike the NASDAQ, which has already broken its resistance line on both the futures and the ETF real money market, broken above this resistance line. That is bullish. The NASDAQ is leading again. That is bullish. PPI, much better than expected. Again, bullish, even though the stochastic is getting overbought here. Overbought can remain overbought for quite a while, especially when we're in a strong uptrend. Here's an example. Boom, another one, right? We can remain overbought for quite a while. So I don't use the stochastic to call tops in a bull run in an uptrend. Instead, I use the RSI instead. Here's the RSI down below for the S&P 500. We're getting somewhat overbought, not nearly enough to call a top. Look at this. We get significantly more overbought usually before the market tops. Again, significantly more overbought, significantly more overbought. We're not quite there yet. That tells me that, again, I favor a continuation of the rally to the upper edge of the range. So again, not quite overbought yet. Not quite overbought. We still have more gas in the tank for bulls to take this higher, for buyers to continue this move higher. That's why I remain bullish. That's why, again, I expect a rally to the upper edge of the range and then a pullback to the bottom of the range. That's now my expectation. And fundamentals support this. Now the technical support this, the technical structure, the recovery of the range supports this, and the fact that the RSI is not quite overbought enough to look for a pullback. S&P 500 futures still not quite at the level of the resistance line. However, we did recover the bottom of the range, which is what I was expecting. 5,440 done. And now I expect a continuation higher. By the way, everybody, this all assumes that CPI comes in line or better than expectations. Obviously, fundamentals overrule technicals. And if CPI somehow, some way surprises with much higher than expected inflation, then we could easily retrace the move that we saw yesterday. Now let's take a look at the VIX. The VIX continued to move down. It formed this hammer candle right before PPI, which really had me worried for a little bit. However, the VIX hasn't really acted or shown us any bearish signals so far. It continues to move down, continues to signal continuation moves to the upside. We've now filled the gap at 18.5. We will likely continue to move all the way back to the bottom of the range for the VIX at around 16. Right, and then we get that a second spike in the VIX, and finally we get that pullback in the S&P 500. Right now, there is absolutely no evidence to suggest that we should short the market or exit or anything like that. All signals continue to be bullish. Let's take a look at the Russell 2000. My upside expectation for the Russell is right around this prior level of resistance. Here it is. Boom, once, twice, 3 times, 4 times. Clearly a significant level of resistance at around 210 to 211. So I expect the Russell to rally to that target of 210 to 211 and then give us a pullback, right? And then give us a pullback, then move back higher to the end of August and top at the end of August. NASDAQ relative to the S&P 500, I talked about this key market indicator at length in my last video. We had this bullish divergence, double bottom with a bullish divergence. RSI put in a higher low. And look how perfect this indicator was. It called the bottom perfectly. We called this bottom to the day, saying, look at this. We have a bullish divergence. The NASDAQ is now leading the market again, which is positive. And then we had this slow melt up higher. Since then, we're now above the 9 and 10. We're now above the 10 and 5-day moving averages on this ratio chart between the NASDAQ and the S&P 500. We're now at the 20-day moving average, and the NASDAQ will likely continue to outperform the S&P 500 well into the end of the month as tech leads the market back out of this correction. XLY relative to XLP, that is consumer discretionary relative to consumer staples. We had a clean breakout yesterday, closing above the 10-day moving average. Likely this ratio chart rallies all the way back to this prior neckline. That means consumer staples, that means consumer discretionary is expected to outperform staples by 3.68%. That includes Tesla, that includes Amazon, that includes any consumer discretionary stock. That means if you're looking to hedge, you should actually wait for this chart to rally all the way to the neckline and then potentially look at a hedge in the XLP or S&P 500 Consumer Staples ETF. High yield bonds, I talked about this at length in my last video. Smart money up top, S&P 500 down below, or I should say what is usually considered dumb money. High yield bonds rallied and exceeded these prior highs. The S&P 500 not quite done that yet. That told me that smart money was buying. Smart money has already almost recovered these prior highs. It told us that market was bullish. Smart money was positioning for a continuation to the upside. I also talked about this chart. This is the S&P 500 relative to gold. It is consolidating, it is bottoming, and we are likely going to get a big breakout in S&P 500 performance relative to gold. That is typically bullish. When we get a bullish cross in oversold conditions below the zero line on the PPI, it gives us a very clean buy signal. Look at these buy signal. Absolutely incredible buy signals. We're not there yet, but we're getting very close. Another key chart that I discussed in the last video is the put to call ratio. I even have this drawing from the last time I covered this. We were above 1.1. We crossed back down below 1.1. That's the first step in establishing a buy signal. The second step is for the PPO to cross back down. That would give us the buy signal. Here's an example of a similar buy signal. Crossed back below 1.1. PPO crossed below. A PPO produced a cross down. That gave us a buy signal. It called the bottom. It is very possible, by the way, legends, for the CPC and PC put to call ratio buy and sell signals that I follow not to produce any buy signals until the end of October. In fact, we could get rallies in the S&P, then pullbacks, rallies again, pullbacks, so on and so forth, especially because of that bearish September and October seasonality in election years, that we could very well not get a buy signal for the CPC and PC well into October, because these signals usually only flash for major trend reversals. That means usually when we get a buy signal, the market will continue to rally for several months afterwards. 50-day breadth, it is improving, forming higher lows and higher highs, not quite back at the highs, but is improving. 200-day breadth, consolidating, not yet seen that big breakout in breadth. That is because this rally is being led by the big cap tech names, Nvidia, Apple, etc. And usually breadth breakouts happen late in the rally. Here's an example. Market rallied for several weeks. Breadth just moved sideways. Then we got the big breakout and it corresponded with that last leg of the rally. That is usually how it happens, everybody. We get the rally going on. Big cap tech leads the rally, and then breadth expands at the end of the rally. And usually that's when we pay very close attention to a big market reversal and look for that key top. TLT relative to the SPY, this is the imminent doom indicator. I talked about this again at length. If you're a long-term investor, you will want to watch this chart and the yield curve inversion to time the final top in the market. Not quite there yet. For the final top, we need TLT relative to SPY to close above the 10-month moving average. That would give us a check mark for the imminent doom indicator, indicating a recession-led correction. You want to see XLP relative to relative to SPY, that is consumer staples, relative to the S&P 500. You want to see this chart closing above the 50-week moving average. So far, no cigar. We rejected. Here's an example. It called the top exactly to the week in late 2021. The third and final key signal, it is the yield curve inversion. You want the yield curve to revert, that is to exit inversion, to normalize for the 10-year yield to begin giving you a higher yield versus the 2-year yield. Not there yet. Usually it happens, it uninverts, it normalizes near the end of a major bull market, ahead of a recession. It even preceded the 2020 pandemic recession. It obviously is not a future predictor or anything like that. It did not foresee the pandemic, but the pandemic did happen as the economy was actually already weakening. That's why that Fed rate cut really saved the markets in early 2020. Let's take a look at the fear and greed index. We're still in fear. Look at this, 25, still in fear, still consolidating here below, even though the market is rallying. That is usually bullish. That means when fear switches to neutral or greed, we'll still have more runway to move even higher. Stock market strength, it is still weak, but it will begin to turn back around. Breadth has already begun to turn back around. Put to call ratio has already begun to turn back around. And junk bond demand is now beginning to rise again. Safe haven demand beginning to reverse again. All the signs that you want to see as the market forms that key market bottom and V-shaped recovery. Tomorrow we'll have inflation data before the market open. Thursday we'll have retail sales before the market open. And Friday we'll have the Michigan consumer sentiment. That means if we try to game this and plan this based on the economic calendar, we can expect a continuation higher to the upper edge of the range on bullish CPI if CPI comes out bullish, and then potentially a pullback based on weak retail sales and weak consumer sentiment, and then we continue to rally the week after that. Let's take a look at the final chart that I want to discuss today, and it's this. I talked about this in the last video. Here is the bullish percent index put in a lower low versus this prior low, even though the RSI put in a higher low. This called major bottoms in the past. I discussed this at length in the last video. Continues to look bullish, continues to look like a classic bottoming formation. Here's the 4-year election cycle market seasonality. Please screenshot this and save it. We are currently somewhere in here in the election cycle. Please screenshot this and save it if you need it. If you enjoyed this video, please drop a like. Consider joining the Discord community to support the channel. If you watched till the end and you did not enjoy the video, I still thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.